Global stock markets closed on the Thursday in a mixed territory as the investor juggled weakness in the United States technology share, the broad losses across the Latin America, and the cautious trading in the Europe and Asia. Also, volatility indicators ticked higher than ever, reflecting the unease over the monetary policy, the economic growth, and the ongoing geopolitical tensions such as the United States tariff. The United States market tech sell-off the leads decline. On the Wall Street front, the Dow Jones Industrial Average inched up just 0.02% to reach 44,922, supported by the defensive blue-chip stocks. But the overall tone was negative. The S&P 500 slipped 0.6% to reach 6,400 and dragged down by the declines in the technology, consumer discretionary and cyclical sectors. The Nasdaq also composite heavily weight towards the mega cap tech stocks fell 1.46% to reach 21,300 as the profit-taking hit high growth names amid the concerns that stretched the valuation that could falter in the higher for longer interest rate environment. The small caps also struggled. The Russell 2000 dropped 0.78% to reach 2,276, reflecting the pressure on the domestically focused firms more vulnerable to credit and suspending conditions. Signs of the investor caution were also visible in the CBOE volatility index, that is VIX, which rose nearly 4% to the 15.57, highlighting the growing demand for the downside protection ahead of the upcoming inflation data and fresh commentary from the Federal Reserve officials. The analyst noted that while the corporate earnings have held up, the sticky inflation and a robust labor market could push the Federal to delay the rate cuts, limiting the further equity gains after a strong first half of 2025. Canada, the commodities drag on the stock. The north of the border, the Canadian markets mirrored the United States weakness. The S&P TSX Composite Index fell 0.35% to 27,823.88, while the S&P TSX 60 slipped 0.15 to reach 1,652. Losses were concentrated in the energy and the mining stock, pressured by the softer crude oil and copper prices. The strategist emphasized that the Canada's resource-heavy market remains sensitive to the global commodity demand, particularly from the China. Ongoing trouble in the China's property sector have also weighed on the industrial activity, have also dragging down the prices for the base metals. The commodities, oil hold nearly year low. The commodity markets were subdued. The WTI crude oil settled flat at the $61.77 per barrel, near the bottom of its 52-week range of $55 to $79. The Brent crude oil was unchanged at the $64, also trending closer to the lower end of its range. The oil remains caught between the weak demand signals, especially from the China, and the steady supply that from the OPEC plus producers. At the same time, the geopolitical risks are high in the Middle East, and shipping disruptions also have provided some price support, preventing a deeper slide. Traders are awaiting inventory data and demand outlooks from the International Energy Agency and the OPEC for the clear directions. The natural gas also traded flat at $2.77 per MMBTU, with the prices stuck at $2 to $4 range over the past year. The United States inventories remain comfortable after a mild winter, and also demand in the second half of the year will depend on the summer weather pattern and the LNG export flows to the Europe and Asia, where the natural gas remains the key to the replacing of the Russian supplies. Also, precious metal stability at the high levels. The safe haven demand kept the precious metal steady. The gold closed unchanged at $3,358 per ounce, hovering the near record highs within its 52-week band of $2,500 to $3,500. The analyst said that the metal continues to benefit from hedging against the economic and geopolitical uncertainty.